So, you want to learn how to invest and get started to this game. Before we get started, I do have to assume that you know nothing about investing. Meaning, all you know is that there's a stock market out there, and people make money in it, but you don't know how to get into it, you don't know how to buy, and you don't really know what you're buying. Investors have been debating the merits of active versus passive investing for a while now. In this video, I will give you an explanation of the differences between these two types of investments and give you steps of how to choose the best option for you. Watch this video to find out the pros and cons of active investing and passive investing. I want to share everything I learned with you so that you can be more informed before making any investments of your own. Before we get started, my channel is all about money and investing, and I know it's going to help you to learn a ton. So, make sure to subscribe and hit the notification bell for new videos every week. And now, let's get right into it. We hear active investing and passive investing terms get thrown around a lot, and actually a lot of people mix them up. I know this can be confusing. I actually have a degree in finance, but I didn't even learn this stuff in school. And now let's break down those concepts and explain why both strategies can have a role in your portfolio. What does it mean to be an active investor? Active investments are funds run by investment managers that seek to exceed a benchmark over time, such as the S&P 500 or the Russell 2000. It is an asset allocation strategy with high relative frictions that attempts to beat the market return on a risk-adjusted basis. The goal of active investors is to beat the market or outperform certain standard benchmarks. It involves an analyst or trader identifying an undervalued stock, purchasing it and riding it to wealth. For example, if you're an active investor, your goal may be to achieve better returns than the S&P 500. The fact is, in S&P's analysis for active U.S. mutual funds in 2018, only 18.5% of active U.S. equity managers have beaten the market over the past 3 years. That's mean you had around an 85% chance over 10 years of holding a poorly performing actively managed fund. What does it mean to be a passive investor? Passive investments are funds that are intended to match an index's performance, not beat it. It is an asset allocation strategy with low relative frictions that attempts to take the market return on a risk-adjusted basis. The goal of passive investors is to get the index's return. It avoids the analysis of individual stocks and trading in and out of the market. For example, if you're a passive investor, your goal may be all about taking a buy and hold approach, typically with an index of stocks. Goal would be to match the performance of certain market indexes rather than trying to outperform them. Based on statistics from the Investment Association, passive funds made up 15.7% of retail fund assets at the end of 2018. And for the S&P 500, that average annual return has been about 10% over long periods. What are the pros and cons of each approach? If you're a highly skilled analyst or trader, you can make a lot of money using active investing. Unfortunately, almost no one is this skilled. Sure, some professionals are, but it's tough to win year after year. Whereas, it is much easier to invest passively than to invest actively. You don't have to do the analysis, pick the individual stocks, or do any of the other legwork if you're passive. Not only does it offer lower costs, but it also performs better than most active investors, especially over time. Also, buy and hold investors can defer capital gains taxes until they sell, so they don't ring up much of any tax bill. For example, ETFs are typically looking to match the performance of a specific stock index, rather than beat it. That means that, whatever they are, it literally mechanically replicates the holdings of the index. Therefore, fund firms should not pay for costly analysts and portfolio managers. I already did a video in my channel about how to choose the right ETF. Please check it out for more information about ETF. I also will put the link on the top of this screen and down in the description. Bottom line. There are some positive and negative aspects of active and passive investing. But, if you feel like you're an investor who wants to think about managing his own portfolio, then I recommend educating yourself. Of course, if you have fun following the market as an active trader, then by all means spend your time doing so. But the vast majority of investors would be better represented by passive investing. Likewise, you may already be making passive investments through an employer-sponsored retirement plan such as a 401k. If you're not, it's one of the easiest ways to get started and enjoy the benefits of passive investing. Thank you for watching. If you enjoyed this video, then make sure you subscribe and hit the notifications bell so you don't miss a single video.